Yeah, I believe all you are good, and we continue with the business data analysis. And today we continue by looking at a question on consolidated financial statement, which you have seen now they are testing in the business data analysis. So they are testing whether you still remember the knowledge of doing the consolidation. And today we shall look at a question just as a basis, where we are looking at a question with just one subsidiary that we are acquiring, and see how we do the consolidation both in the income statement, statement of profit or loss, and in the statement of financial position. So the question reads like this: Kuja Limited has owned 70% of Twende Limited equity share capital since April 2017. The acquisition consideration consisted of cash amounting to 36 million paid on 1st April 2017. The retained earning balance of Twende Limited at the date of acquisition stood at 870 million and had no other reserves. The draft financial statement for the two groups of companies for the year ended that 1st March was set out as below. You have been given the statement of profit or loss and other comprehensive income there, and statement of financial position there. Additional, a fair value exercise carried out on 1st April 2017 concluded that the carrying amount of Twende Limited net assets approximated their fair value, with the exemption of an item of plant and equipment which had a carrying amount of 100 million below its fair value as at 1st April 2017. So you can see the carrying amount was 100 million below the fair value. In other words, the fair value was more by 100 million. The plant and equipment had a remaining economic useful life of 10 years. Depreciation is charged to cost of sales. It is a group policy to measure non-controlling interest at fair value at the date of acquisition. The fair value of non-controlling interest in Twende Limited on 1st April was estimated at 1370 million. Kuja Limited Group adopts revaluation model to measure its property, plant and equipment permitted by IAS 16 PPE. The revaluation surplus reported by Twende relates to the revaluation conducted in the post-acquisition period. During the year ended at 1st March 2022, Twende Limited sold goods worth 200 million to Kuja Limited. Twende Limited reported a gross profit markup of 25% on all its sales. Kuja Limited still had 25% of these goods in its inventory as at that 1st March 2022. As at that 1st March 2022, Twende Limited records showed a receivable due from Kuja Limited of 140, which corresponds with balance in the Kuja Limited trade payables. An impairment review conducted on that 1st March 2022 revealed that goodwill arising on acquisition of Twende Limited was impaired by 10%. No impairment loss had been reported in the prior years. So you required group statement of profit or loss, another comprehensive, and group statement of financial position. So we shall start with this one. Yeah, let's start with this one. I'll just copy this text and I will just prepare it here. Yeah, let me just prepare it here. This is Kuja Limited. Kuja Limited, and I'll paste this here. Yeah, group statement of financial position. Yeah, group statement of financial position. Let me just merge that and center. I'll copy these and I paste it here. Yeah, that way. And yeah, so that one I'll use here. If there are any workings, I'll do them down, but the key workings under this question that will enable us, remember when you're dealing with subsidiaries, just but a simple addition, but you'll find that in this case I first control bold, and even this one control bold. The first one, we are told we had a fair value, so we shall calculate what we call the fair value depreciation. Let me do my workings here. my workings. We do fair value depreciation, and it was for plant, whereby this plant had a value of 100 million, and we divide by 10. Yeah, so this will be equals to 100 over 10, which will be 10 per year, and we have what we shall call accumulated depreciation. When you count from April 2017, those are how many years? Because we are reporting on 2022 March, so 2018 will be 1 year, 2019 2 years, 2023, 2021 4, 2022 they are 5 years. So for the accumulated depreciation, this one it will be equal to this by 5, multiplied by 5, which will be 50 as our accumulated depreciation. The other thing that will affect the income statement profit or loss will be note number 4 for the intercompany. The intercompany sales, and remember under intercompany sales, during the year 20 sold goods worth 200 to Kuja. So these are an upstream. 20, remember, is our subsidiary. It was a subsidiary selling to the holding, and the selling price was 200, which we shall remember to eliminate that. Our selling price was 200. Our selling price was 200. Selling price was 200. And our UPCS, we have to calculate our UPCS and realized profit. This will be equals to 200. We are selling at a markup of 25%, so we shall multiply by 25 over 125 because it was a markup, and again the proportion that remained was 25%. We multiply by 25%. That is what remained. By the end of the day, again we get our UPCS of 10, and I think that is a key thing that we have, so that while we are consolidating our revenue here, we shall get the revenue for these plus the one for this, and we minus the revenue for Kuja, you had revenue for 20, and we minus the intercompany sales, and our intercompany sales were 200, and you'll get that as our total revenue. The cost of sales, we shall take the cost of sales over this one, and we minus, so remember this one already is negative, so we shall add sorry, let me just come back here, plus so this one we shall have to add this one for Kuja, and because both of them are negative, we shall minus, because our figure is these are already negative, we minus the UPCS, our UPCS and depreciation, fair value depreciation, and again we minus the UPCS for the year, and we enter, just confirm, 5180, because this 50 and 10, that is already 60, this one is 5160, then you add 10 10, 5180 is okay. Alt equals to get the gross profit, then distribution is direct, just is a sum of the two, this one, and you add this one, you enter, admin the same, equals to this, there is no adjustment for that, and you add this, enter, alt equals to get the operating profit from the gross profit, alt equals that way, you get that. Our investment income, they did not pay dividend, so just pick it again, direct addition there. Then finance cost, again there was no any interest that was paid, there was no intercompany, it's just but a direct addition, and you use alt equals from there to get that. Just put the top border. Even here we needed the top border, even here we needed the top border, that way, so that our profit before tax, our income tax equals to, again is direct for the income tax. You add this one, you enter, and again profit for the year, alt equals this one, from this you enter, and other comprehensive, we have the gain. Again just a simple addition for the two. The assumption will be that this 100 for the 20 was the 100 that we had under the note number 1, the fair value. So the assumption, it will have been already no, it should not be the one, but now we had 100, the gain on revaluation, property revaluation of 100, and here we have another 100 that was there, so that you get the 280, and the total comprehensive here we shall use. So here you have a top border, so here is alt equals, again I add this and I enter. So that is our total comprehensive income, and under that let me add a row here, insert a row, so that here we shall less NCI, less NCI, share of profit, So since here you'll have a share of our profit, and for the NCI share of profit, we'll put it, you can calculate it here. NCI share of profit, NCI share of profit, share of PAT, profit after tax. So our profit after tax, for them, they will take equals to the profit for the year. For this one it will be 120, and we multiply by 30%. Remember, we are owning 70, so NCI is owning 30%, so for them is 36 out of that profit for the year. And we shall less the depreciation. Here we have depreciation, our portion out of this 10 that we had by 30%. Just take our portion, and this one you're supposed to minus, and minus that, and again the UPCS, our portion, because it was an upstream transaction, and I will start with the negative. This one I multiply by 30%, multiplied by 30%, that way. So alt equals, I enter and get 30, and you have the revaluation, so they'll have a share of the revaluation. So when you look at the revaluation, the surplus for the year was 100. Out of 100 they get 30% again, that way. Alt equals, so the total value that they have will be 60 as our value. So I come back here, and we shall put it as a negative. We less this, the share of 60, we get attributable to holding, attributable to holding company, yeah, attributable to holding company. Alt equals, yeah, that way. So there's something that you have not calculated. Yeah, allow me to calculate that, because you're supposed to calculate the goodwill and it was impaired and you're using false, so even NCI will have their share. So for the goodwill, the purchase consideration, purchase consideration is what purchase consideration that we have. Consideration, under the purchase consideration, we are told we paid 8 something at the beginning. We paid a cash of 3.6 to acquire that, so we paid 3.6. We had fair value NCI, fair value NCI, we have been given somewhere here fair value NCI of it was 1370. Our NCI alt equals the 249, we less fair value less net assets, acquired. Remember, in this case, when we talk about the net assets, they are the reserves. Yeah, they are the reserves. And the first one we have is the ordinary. Yeah, you can just pick it directly. Ordinary shares. We have ordinary shares. The second one we had share premium. Ordinary share premium. They did not have share premium. The valuation was a post. So the next thing then was the retained. They were the only two. And under these, the ordinary was 3,000. The retained were told at the beginning of the year when we acquired it, it had a retained enemy balance of 20 limited. The date of acquisition stood at 870. So our retained was 870. Yeah, 870. And they had the fair value, what we call the fair value gain. The fair value gain on the item that we had here for planned, which had a fair value of 100. So this one we shall minus in order to get our what? In order to get our value of goodwill, and alt equals, we need it from here. So we had a goodwill of 1,000. Goodwill impaired at 10. Goodwill impaired. Goodwill impaired at 10. There is one by 10%. We are told here goodwill was impaired by 10%. So multiply by 10%. So it was 100. So the goodwill and impaired. Goodwill and impaired. And impaired will be the balance. So this one you're supposed to minus this one. So alt equals the two of them. The unimpaired one was 900. Yeah, the goodwill and impaired is 900. So it means here under the one for this one, let me just add insert a row here. Insert just a row. Sorry. So we shall just insert a row, so that in this row we have goodwill impaired. Goodwill impaired, this one. goodwill impaired, which will be our portion, because we are using the full goodwill, multiply by 30%, so it will be 30. And find that our value now, let me just recalculate, it equals, that will be 0, we minus that, so the revaluation will be 30. The only value that we shall remain with there is 30. That one is okay. I believe it has adjusted that. And the other goodwill, the whole amount that was impaired, we shall add it to the admin. The goodwill impaired of 100 under admin, here we shall add that particular goodwill impaired. We add that goodwill impaired of that way, so that our attributable to holding will be 280. And that's how the first part of the question was supposed to be done. The first part was supposed to be done. So we prepare the second part for statement of financial position. So we have Kuja Limited. Let me just copy this. Statement, so I'll control bold for that, control bold. Kuja Limited statement of financial position, margin center, and I will copy these items that I had here up to that, just paste them here, from this cell, that way. So this one is control bold, even this one, equity, total equity, and current liability, and the total. That one is okay. So under this one now, so again here we deal with simple addition, and I'll prepare it. Let me prepare it here. So there are shillings in million, that way. So that for the PPE, so I shall just take a simple addition, and we add this, and we add another thing that we shall add there is the fair value of 100. We had the fair value of 100, and we minus the accumulated depreciation. Now there we had accumulated depreciation of 50, we minus it there. Then the investment, we shall not, investment we shall have 45, and we minus, remember the amount that we invested 36. We only account for the external investment, 36, which was our cost that we invested. I think I had captured it somewhere down there. This one, so we minus that under that, and here we include goodwill, the unimpaired goodwill, we had it somewhere here that we have calculated. That way is our impaired. And we go to inventory. So under this, I think I can insert an entire row. Okay, insert here, insert an entire row. Yeah, that one is okay, so that I get this total. Alt equals that way, put top border for that, and I need to use a 1000 separator. Yeah, that way is okay. So for the inventory, I will have this, and I add this, and I minus inventory. Normally minus the UPCS. Our UPCS, we had calculated it here as our 10. Yeah, that way. So something, just a minute. Under the cost of sales, there's something that will not include. Yeah, we are supposed to minus the intercompany sales, because it will affect both. The intercompany sales of 200, so it affects both the sales and the cost of sales. Yeah, that intercompany sales, it was supposed to affect this and affect that. So the way we minused T61, even in this one, T61 was supposed to be deducted. Yeah, it was supposed to be deducted. I think that one is okay, so that it will increase. So we were okay, that one is okay, because the key thing is supposed to increase this value. Ideally we're supposed to add, because this was 5180. Yeah, 53 is okay, that one. So we continue with this. So for the receivable, we shall add simple addition first. We add this and we add this, and we minus the intercompany balances. Here we are told we had 140 here. Tender Limited record showed receivable due from Kuja Limited of 140, which corresponds to the balance in Kuja Limited trade payable. So we shall minus 140 in both receivable and payable. So minus 140. So for the cash, it's just but a simple addition for the two of them, and we get alt equals. So we need all of them now from here, and we have top and bottom border. Yeah, that way. So equity only the holding company. For the ordinary, we don't consolidate that, only the holding together with share premium. Again, only the holding company. The revaluation, we take our post. We are told the one for this one was at the post, it reflected the post, so we shall add, can open the bracket for that. This one multiplied by 30% by 70, our portion, and I close the bracket, I enter. Retained earnings, we shall calculate that. We do that here as my retained earnings. Retained earnings, my retained earnings. So retained earnings here for Kuja Limited had retained earnings of this for 170, and then Twende Limited, we take the post for Twende. For Twende will be is equals to what we had. I will open the bracket for that. What we had at the beginning, at the end we had 2530. We minus at the beginning the one that we used to calculate goodwill, and the goodwill we had the retained of 870. So I will add, because 870 already is negative. Yeah, to consider the signs, I will add that. I close the bracket and I multiply by 70% our share of that value, so that is which will give us, if we enter that, 1162 as our share. Then we do what? We have the depreciation, the accumulated depreciation. I'll just pick it here. This is accumulated depreciation, but I'll pick my portion only. Yeah, portion of that 50 multiplied by 70%. Then the UPCS. The UPCS again, we just pick our portion for the UPCS. UPCS was 10 by 70% or by 0.7, 70%. And again we take the goodwill impaired. Goodwill impaired. We take our portion again. Our portion of goodwill impaired was this, and we multiply by 70%, 0.7. And for the UPCS we shall minus. We need it negative. And accumulated depreciation we shall minus. We need it negative. Yeah, that way. I think those are the major items that will affect us there. Alt equals, and I enter. So 52.20 as my retained earnings. Yeah, 52.20. I go to 10% low note. This is simple addition. I take this and I add this. Even the deferred tax is simple addition. I take this and I add this. Payable the same, simple addition with an exemption of we shall minus intercompany. This one, and we add this one. Then current tax, we take this and we add this. Yeah, so for the tax is just but a simple addition. Yeah, we shall add this and we add this. No adjustment to that, which will give you 750. Then we alt equals, we add this value. Yeah, from there we'll get 750, 21,570. So let us see whether it balances. No, it doesn't balance, because this one is 23,600, this is 21. So it means it's something, yeah, under the total equity we have not captured in the the NCI share of net assets. Let us deal with it here. NCI share of net asset, NCI share of net assets, NCI share of net assets. So we had fair value NCI here. Pick that fair value NCI, which we had 1370. We had the post acquisition, the retained earnings. That was the post acquisition retained, which we shall take the profit in the statement. Profit in the statement retained, we had this, and you minus the pre-acquisition, the return that we use here. This is the pre, and because this was minus, that means here we shall add. Yeah, we add that and we take our portion of 30%, multiply by 0.3 or 30% to get our retained of 498. Then we had the revaluation, the surplus that we took, our share of the revaluation surplus. Remember our revaluation was 700. We take our share of the revaluation because it was the post, this one, multiply by 0.3 to get that, yeah, to 10. And then we had what? The depreciation accumulated. We start with accumulated depreciation, where we had 50. We take our share of this 30%, which will be 15, but this one now we minus. We need to take it as a minus because it will reduce our value. We had the UPCS, our value, So again we take it as a minus this by 30%, and the goodwill impaired. Goodwill impaired is one. We take our portion, because already this one is negative 0.3, which will be 30, and here we take alt equals, when I enter I'll get my value as 2030. So I'll fix that. That is a NCI share. Already that one it has picked because I think I inputted the formula. NCI share of net asset of 2030, and we'll get your value now at 23,600, and that is how the question is supposed to be done. Remember, in the cost of sales and the revenue we eliminated the intercompany sales of 200. In the cost of sales we added the depreciation, and we added the UPCS, and we minus. The reason this one we added because these two are negative, and again we minused the cost of sales that was there. The cost of sales was supposed to be deducted, and I believe under that, under this one I will do some adjustment. So this one under this, because the figures already were negative and these two are negative, so this one it means I will add instead of minusing. Let me undo that. I just need this one particular formula where I will add instead of minusing that, and find that it will be 49. 4980. That one is okay now. 4980, it is okay, because ideally you're supposed to take 4050 plus this already a negative, plus we minus the cost of the intercompany sales, and we add the depreciation, and we add the UPCs ordinarily. So here you factor the signs, so it will give you that, and you do the other adjustment concerning that. So that's how the equation was supposed to be done. And you have the financial position there. We have done our workings here for the fair value depreciation, accumulated intercompany sales, and share of profit after tax, and we have covered the goodwill there. We have covered the retained earnings there, and after that we have covered the NCI share of net asset. And after doing that, you find that our question is balancing at 23,600. So that's how the question was supposed to be done. So ensure that you subscribe to this channel for more content on business data analysis, for more content on CPA, for more content on ATD, for more content on the CAMS, the CS. All of them will be uploaded, and if you have any query, leave your comment. Any question that you needed to be assisted to tackle it, you can just paste it or tag us, and we shall be able to assist you on how to go about that question. Thank you.